Good afternoon to everyone, and we are here to discuss the topic of the debt bomb. It's a topic that has to do with the wealth of a large number of countries. The numbers are very impressive. It has to do with the future and the perspective of growth in several economic and geopolitical regions. And we have the privilege to discuss this topic here with us with three prestigious voices from three different regions. Mthuli Ncube is professor at economics at the London School of Economics and Political Science in London. Eric Cantor is vice chairman and managing director of Mollison Company in Virginia. He's the former majority leader in the House of Representatives of the Great Old Party. And Minister Ncube, Economic Development Minister responsible for the state of Zimbabwe. So first of all, thank you so much for joining us and also who is following us through the web. I will start with Mthuli Ncube. I remember after the beginning of the crisis in 2008, when President George W. Bush, he had to react. It was a very different time where he was covering the White House at that moment. The choice was to bet on the G20, was the summit in Pittsburgh, and China was a crucial partner. It was helping the West to react, not only the US, to react to that crisis. And from the moment on, we started considering China a big support, big help in guaranteeing growing the growth in the world. But now the numbers are saying something opposite. We worry for the growth in China. We see the debt of 34 trillion US dollars. We saw the action of Bank of China injecting $83 billion in the market to sustain growth. So the paradox is that we had big hopes, we saw big result, but now we have big worry, especially because of the debt. What went wrong?
So everybody's afraid of China's economic situation, and China's afraid of America. So I think there are a lot of global potential risks to the financial markets. But China is slowing down, there's no doubt about that. But I think there's a bit of confusion as to why China is slowing down. And the reason is very much related to the topic of today. It's related to the fact that the government has, in the last 2 years, vamped up efforts to deleverage the economy. Because only a few years ago, the financial markets were saying that China is the next ticking financial bomb. Financial fragility was the real issue in China because of debt. And so what happened was that the government, through a wide variety of measures, were able to stabilize leverage ratios in all sectors, and in fact in financial sectors leverage has come down. Corporate sector debt, although still very high, the leverage ratio is stabilized, and household debt is climbing up, but China really started from a very low household debt, perhaps too low in the first place anyway. So we are seeing the consequences of a deleveraging cycle to make China safer, although slower. So the consequence of these deleveraging efforts will be to slow down the economy, and rather than perceiving China as having some fundamental issues, whether it's trade war, sentiment, or just a big mess, the deleveraging is a big part of the reason why it is slowing down. That said, I think that people focus, the discourse either here or outside, focus too much on the level of debt. It focuses too much on the symptom, debt levels and growth rates. But we're really not trying to dig deeper into what is causing these symptoms, because they all come down to one reason, and they're not, so focusing just on debt levels is not necessarily the way to think about this issue, in my opinion. China has a massive misallocation of resources because of the functioning or dysfunctionalities of the financial system. Today's challenge is, how do you get credit and resources from the financial sector into the real economy, into the productive firms, into the highly innovative private sector with latent potential? That is China's problem. It is not necessarily the debt levels and the slowing growth rate. So what we're seeing as symptoms has a deeper root cause, which is the financial system, and that will take time to, of course, reform and improve.
Eric Cantor, what we worry the most is the overlapping between the two crises, China and the U.S., because of the U.S. debt that is by 21.9 trillion U.S. dollars. I saw the Chairman Powell of the Fed said a couple of days ago, I worry a lot about the debt. It's a long-run issue, but we have to face it. What is he really meaning? What U.S. has to face that didn't yet?
Well, I think I suppose that Chairman Powell and those remarks he was referring to is the debt at the federal government level. And you, Maurizio, just spoke about the historic levels of that debt. And it is something that we've struggled with in the U.S. For now 15, 18 years, in which we have run a deficit at the federal level. And we also have a debt at the state levels. We have unfunded liabilities in our pension systems at the state levels. So there is a lot, certainly, of debt in the public sector, not to mention in the private sector in the U.S. I think one of the things that has been a constant theme, though, in the U.S. Congress is how do you deal with this sort of demographic challenge that the U.S. is facing, together with our health care costs that are continuing on the rise. And that's really the essence of the problem at the federal level. And if you look today, we'll probably face a deficit of $1 trillion in the U.S. this year. We are experiencing that largely because every day in the United States, 10,000 people turn 65 years old. And when you're 65 years old, you become eligible for what we call our Medicare system, which is our system for seniors' health care. Well, that program, Medicare, happens to be 50% underfunded. So every day, it's 10,000 people times 50% underfunded. And that's how you so quickly mount this deficit every year. And there's a constant argument in Congress and policymakers, how do you fix that? And you've seen the Democratic Party come forward with a proposal for even more health care coverage, even more liability at the federal level. My party, the Republicans, have tried to say we need to reallocate the risk and allow patients, beneficiaries assume part of that. But that's on the government side. And we know how to fix it. We just haven't seen the political will mustered to actually address that real problem. On the private side, I mean, obviously debt has been a big fuel to economic growth in the U.S. And when you couple Chairman Powell's statement and about the low interest rate environment that we have experienced in the U.S. almost since I was a kid. I mean, we have been a very long time for low interest environments. And so we've gotten used to that. And any time, and I think that what we see, and at some point the markets are beginning to view the likelihood of a reversal of that trend and an increase in rates as more likely. We don't really know how the American consumer is going to react. I guess we could say if rates go up, something like housing, which is a big part of our economy, that's obviously going to affect the American homeowner when they try to repay their debt and repay their mortgage. And once you have increased interest costs, obviously the price of housing ultimately is going to go down because more is going to go towards that interest cost. And the same thing will happen with companies. If this trend really does develop, and on the corporate end, I mean, we've obviously been, some of the deepest, most sophisticated capital markets in the world. But on the corporate end, the high yield product in which many companies have undertaken, and if you're highly leveraged, what happens is you're not really going to benefit from the tax benefits that have occurred. Here come interest rate rises. I mean, that's a real difficulty and challenge for the private companies that are highly leveraged. So we don't know how all this will play out, but we suspect it's going to impact valuations, just like in the consumer end, it'll impact home prices in the private sector. Nonetheless, as you know, our economy continues to chug along in a very robust fashion, so we'll see.
Minister Ncube, the third part of this triangle are the emerging market. First of all, the minister represents the state of Zimbabwe. We appreciate very much being here, considering the situation on the ground in your home country. But exactly starting from the riots and this difficult situation that you're finding in because of the question of the debt, speaking more in general for the emerging countries. How an emerging country can avoid to be entrapped in the debt trap?
First of all, 30% of African countries are already in a debt, in an unsustainable debt position already. And this has been happening almost by stealth over the last 10 years, since 2008. The reason being that one of the effects of QE, quantitative easing, was obviously to lower global yields on global debt. So African debt became very attractive. So you've got countries issuing Euro bonds at upwards of 7%, 8%, and the global capital markets are gobbling this up, and every other country is doing it. And so they've been accumulating debt over time, so that's partly the reason. And these resources are being used to finance infrastructure, recurrent expenditure. None of those two really create enough foreign earnings to be able to service the debt in the first place. So you've got a situation where debt stock is rising, but the performance in terms of foreign currency receipts to service the debt keeps dwindling. So that is a problem. Also, what has happened is that with the collapse in the oil price, or rather the shift in the collapse in the oil price down from $100 per barrel down to where it is now, and it used to be lower, means that the growth that was supporting what you call a comfortable debt sustainability framework is no longer there, because you need growth. So that gap between growth and the nominal interest rate that they are paying has narrowed because growth has shrunk. So that's part of the problem. And also what has happened is that some of these countries, if not all, are no longer running primary deficits, or rather are no longer running primary surpluses. They're running deficits. We know that in the debt accumulation equation, that the moment you stop running that primary surplus, you start accumulating debt. When that gap between interest rate and growth narrows again, you just start accumulating debt. That's what is going on in these 30% of the countries in Africa. Coming to Zimbabwe specifically, Zimbabwe's problem is actually different. It's not a foreign debt issue in the sense of debt sustainability challenge there. It's actually a domestic debt issue. But on the foreign front, what's happening that we have actually a balance of payment issue, a problem, and Zimbabwe doesn't have a domestic currency. It uses US dollar and partly cryptocurrency. So all of that is compounding its ability to service its foreign debt, but it's not a debt sustainability challenge, rather it's a domestic debt issue rather than a foreign debt issue. If a domestic debt plus foreign debt, if a domestic debt is about 45% of GDP, foreign debt is 55% of or rather the other way around. Domestic debt is 55%, foreign debt is 45% of GDP. Now going forward, how do we deal with this in Africa? Really is about the fiscal side of things, that countries have to start running primary surpluses on the fiscal front. The fiscal discipline is the key, absolutely. And they must stop borrowing to finance infrastructure. You don't export roads, so you must make sure to use the bulk of the financing must come from the domestic sources or public-private partnerships, so BOTs, and so forth. When I became minister, I influenced 3 projects. I moved them from foreign financing to either domestic financing or BOT type financing. One of them is the a big hydro project, in fact, between Zambia and Zimbabwe. The Patoka Gorge is about $5.2 billion project, which we have moved away from direct government financing to a BOT project between Power China and GE. So they're going to do that on a 25-year concession and just get on with it. We don't have the money to spend on that project. The other one was a road between from South Africa, from Beitbridge all the way to Harare. That's what 800 kilometers or so, all the way to Chirundu, which is border with Zambia. Again, we moved that to a BOT arrangement, but making sure that it is domestic capital that is being applied as opposed to foreign capital. Foreign capital is only about 30%. So that way, when you do that, then it begins to make sense that do not finance what doesn't earn export receipts or foreign currency receipts with foreign loans, but rather use domestic loans. So that's the nature of the debt situation in Africa. So you'll see a few countries now begin to get into debt restructuring mode And I hope that we're not at the tipping point of another HIPIC, round of HIPIC initiatives to extinguish African debt. But it's beginning to feel like that. And I think that African countries should really wake up and start dealing with it at a policy level and start instituting the right fiscal measures to make sure that they can reduce the debt stock.
What is coming out from what you all just said is that we have a common fear, but very different approach and agendas, because for China maybe reform, for the US can be interest rates, and from the emerging markets and in Africa especially a new frame, as the minister said. But if we have these three different perspectives, and we have to add also the European Union that is more or less in the same position, even in a worse situation on some regard, may we have the need to find a common strategy to fight the debt. So maybe the debt, the new topic that the countries have somehow to take it together. And maybe the G20 the place to do it, or we have to find other architecture to tackle this danger, common danger. Professor Kim, you want to start?
I do think that a consensus that rising debt will potentially become an issue and a risk to the financial market, that there has to be some consensus and some awareness that these are things to focus on. However, I do still believe that in different parts of the world, what is driving the debt cycle and what is driving the debt levels are quite different. And for instance, in advanced economies, we're going to be stuck with persistently low interest rate for a while, and low interest rate fuels borrowing and asset prices. So when interest rate goes down, there will be more impetus to borrow. So that is a different reason why, let's say, China has had a higher debt level, and that has very much to do with the kind of 2009 fiscal stimulus that China implemented to deal with the recession, created this shadow banking sector and various kinds of more risky activities. And for emerging markets, the issue, along with borrowing, is the currency mismatch. It's the balance sheet. Is how much, as the minister has alluded to, how much borrowing you are in, let's say, dollars, and of course, with the recent macro trends of potential rising interest rates, that's going to set off a huge global cycle that could potentially really hurt emerging markets. But for instance, China, although debt levels are high, have very little foreign borrowing. And lastly, with regard to infrastructure, now, of course, China has rolled out this Belt and Road project, which I think that in a world with persistent lacking aggregate demand, the fact that there is investment, there is this push for raising demand through infrastructure, is potentially a good thing. But of course, the risks associated with accumulating more debt and the uncertain returns to infrastructure projects is something that China needs, as well as the other countries needs to consider.
Eric Canto, is there a way to consensus?
Well, listen, I think your question was sort of in the context of everyone is coming at it from a different approach right now. And as the largest economy in the world, as one that obviously with the reserve currency, the U.S. can make a difference in this. And I think that you sort of have a collision right now on this potential debt bomb with the issue that is probably one of the top political issues in the U.S. right now, which is the trade dispute with China. And, as we talk about the growing amount of debt and we talk about its relevance, it becomes relevant when the economy stops growing enough and there is an inability to sustain that level of debt. And that's really what we're talking about now. And so if the global economy doesn't continue to grow. We've already heard about the slowdowns and the reasons for that the professor talked about in China. And I also think that the issue of trade, and if this trade dispute is not resolved, it can also be very harmful to the economic growth, both at home in the United States, and it can create a contagion. It'll impact China for sure, but I think all of the other countries that derive their trade activities from this big relationship with the U.S. and China are going to be impacted as well. So I worry about that. And again, we are in a very unconventional political sort of mode, not just in the United States. I mean, we see it everywhere, but certainly trying to resolve that issue everyone claims a win, and we can get on with the continual sort of globalization of supply chain and provide a little bit more certainty as an economic community globally, I think could go a long way to trying to address, or at least put us in a position to address the debt problem that we've been talking about. Now, I do think, this year, just more immediate, the trade issue is certainly in possible resolutions immediate. We also have, I think the figure is about $2 trillion that will come due this year that will need to be rolled over throughout the globe. And that has to do with investor psychology, because you're going to get rollover if investors believe that rollover is coming, believe that the growth is there, because borrowers will be able to replace the loans with new loans provided by those investors. And that gets back to the lack of volatility, more certainty, more optimism as far as countries getting together. So again, inherent in your question is the answer, yes, we should all sort of focus on this together. Easier said than done.
No, I agree. That I think really the consensus is that there is a debt bomb. Yeah, I think we all agree on that. But there are different reasons as to why we have it, and it varies across the U.S., China, Africa, and other emerging markets. But also the solution to tackle it will also be different, absolutely. But we recognize the problem. For Africa, the conversation has already started in terms of platform, and one platform has been let's say, through the Bretton Woods institutions, for example. We all have some kind of Article 4 visit from the IMF every other year or annually, and that often brings up stuff about the debt position, debt sustainability, and we're having these conversations, and each country is now beginning to look into how they deal with their situation. And as I said, in Africa, it's quite common that really the solution is through the fiscal angle, making sure that we can institute some fiscal discipline. That's really the way to do it, and also curtail the funding, especially of infrastructure or recurrent expenditure through foreign borrowings. And just by doing that, that's already a start. So the platform is already there. The conversation is taking place. We all have sort of club of finance ministers, clubs of central banks within our regions at a continental level. The conversation has already started.
Okay, I believe that now we can pick up some questions from the floor. Please raise your hand, identify yourself, and please.
My name is Michael Rubinoff. I was curious, Eric, you said it's 10,000 people a day?
Yeah.
And so that adds, I don't know what, that's a big part of the trillion, that's most of the trillion, it's more than a trillion, and so there's, but in any event, there's debt being added to the current 20 trillion at the rate of $1 trillion a year. We're 10 years into a recovery. There's no discussion. There's a discussion on the trillion, but no discussion on the 20 trillion. Right. And that, I don't think in the history of the country that's ever happened. And so I'm curious how that's reconciled with the notion that from Professor Q, is that how I say it? Okay. That we'll be with low interest rates in this country for a long time, I think you said, and how you reconcile that. And also, Eric, I'm not going to let you off the hook. There's no discussion of the 20 trillion is a Republican issue that's not addressed. No, there were two questions.
All right, so I'll take the political angle first, and then leave it to the professor to answer, because I'm very curious as to the answer as well. But I think, first of all, in order for us to focus on the question of the 20 trillion, we got to open the government first. Which again is, I say that in jest, but again, that is indicative of the political state in Washington right now, is there is just very little political agreement on almost any issue. And during the time that I spent on Capitol Hill, the 14 years that I was there, a majority of that time, my party was very focused on trying to address what is now that 20 trillion. And again, it's reflected in the unfunded liabilities of the Medicare program. Again, if you remember, it was the demographics plus the rise in healthcare cost. And just as we've seen over the period of years in the private sector, what companies have done to deal with legacy healthcare costs, retirement costs, they've shifted some of the risk onto the beneficiaries There's a reason why we have defined contribution plans now, not defined benefits. The same theory was being applied by my party and posited to fix the Medicare program, essentially saying that you cannot sit here and expect the taxpayers to assume all that burden, and there needs to be more injected into it to provide a much more actuarially sound future for the Medicare program. Again, it got into the political debate where then President Obama said it changes the nature of the quote-unquote safety net, and therefore we're not going to do that. And now we have a president in my party which is saying, I'm not even touching that question. So you're right. Far too long that it hasn't been dealt with. But again, it's reflective, I think, of the state of affairs. So.
There are global trends, persistent global trends that are pushing down the real interest rate. And despite the fact that there's a lot of borrowing, increasing in debt, the truth is that global saving is still outpacing the growth of global investment, and that trend will push real interest rate down. That could be attributed to multiple factors, including the fact that emerging markets are bringing into the capital markets this massive amount of saving. It could be also because of demographic developments in advanced economies, but also technological. In today's world, capital used to be a storage of value. Today, we don't really need, with the likes of Amazon and these internet companies, we don't need so many malls and big physical spaces. And the investment demand, the notion of investment demand, where we used to build factories and now, we have Facebook and Uber with very little capital investment, has fundamentally changed this relationship between interest rates and investment. So unless we think that these trends are only temporary, then I think the low real interest rate might be around for a little longer.
We still have time for another question. Somebody else? Yes, please.
Pier Giorgio Sandri from La Vanguardia, Spain. In this context of such a level of debt, would it be desirable that the central banks take a pause in rising interest, and what do you think they will do finally?
Please.
I'll leave it. Okay, go.
No, I'll just add one thing. It is, keeping nominal interest rate low for a long period of time is one of the key reasons for increasing the financial risk. Right? Asset values are rising, not necessarily because fundamentals are so great, but interest rate policy rates are low. So also another point is that given the pressure of the next recession coming in, where's the policy room? Where's the policy room if fiscal capacity in the U.S. is already limited and nominal interest rate, if staying low, that will mean a bleaker picture for when the next recession comes.
Yeah. I would say in the African context, really the trick is to shift to domestic capital markets, domestic borrowing, and deepening domestic capital markets. That's really the way forward. And then if it's about funding infrastructure, is more use of public-private partnerships, crowding in the private sector, the pension fund system, and others, the long-term contractual institutions, life companies and so forth. That's really the way to go in terms of minimizing exposure to global capital markets for financing things for which you don't earn any foreign currency at all to service the interests of that. But also it's in realizing that at the end of the day, you cannot have a debt sustainability framework that's driven by an administrative arrangement. So for example, in Zimbabwe, there is something in the Finance Act, Public Finance Act, which says that public debt should not be more than 70% of GDP. But that's very useful at the beginning, but debt sustainability understanding should be dynamic. It should be an interplay between the cost of borrowing, the rate of growth of the country, and also the ability to manage the fiscal side. Basically your primary surplus and deficit. That's an issue. Your primary balance is very key. So making sure that debt sustainability frameworks are dynamic as opposed to administrative pronouncements is critical.
Summarizing the panel we just had, let me thank you, the panelists, for this enriching conversation that indicated how much different the approaches are and how common the need is to tackle and to have a common conversation, as the Minister suggested to all of us. And thank you for joining us here and also for the web. Thank you all.
Thank you very much. Thank you for the moderation. We appreciate it. Thank you very much.